Hey gang, welcome to Time in the Market episode 1. This is a series of videos that I plan to do for as long as I can and hopefully forever. And essentially I want it to be a way to track the journey that I experience as an investor, all the trials and tribulations through up and down markets and to have an outlet for discussing stocks with people who may have the same interests as me. In essence, I just want to have fun with this. This is not meant to be educational, although I'm sure it will be. I do have a finance degree, but I'm not a licensed financial advisor, so don't take anything you hear here as the gospel, and certainly talk to a financial advisor before you make any decisions based on what you see and hear here. But I just thought it'd be fun to make a series of videos like this that says, hey, this is where I am this week and this is where I'm going next week. And that's essentially what this is going to be. If you're interested in stocks, if you're interested in following somebody along their journey of investing, I think Time in the Market is going to be a good time for you. If not, don't worry about it. It's not for everybody. This is the first episode, so I'm totally starting off with nothing here. I'm going to be playing it up as I go along. I'm going to try to make it work, but who knows how it'll go. Things will change, things will get better as far as the episodes go. For now, I'm starting bare bones. I started my microphone. I have some of my portfolios up, and I'm going to share them with you, and I'm going to talk about what I'm trying to do here. So first, my introduction. I think it'd be good to meet all of you guys. My name is Jacek. I'm Polish. If you're not familiar with that type of name, it is a Polish name. I'm a first-generation immigrant that's been in this country for 20 plus years. I'm 35 years old. I've been investing since my mid-20s. I have a long-term investing mentality in the sense that I essentially buy and rarely sell unless something changes. My idea of a good investment is something that I can hold for as long as possible. And I think with these two portfolios that I'm going to talk about here and essentially track within this video series, that's the goal, to sort of stick with these portfolios without too many changes for as long as possible. Obviously, things can and will change. If a company does something that I don't like, I will remove it from these portfolios. If they do something that, changes the way I feel about the risk, I will remove it from the portfolio. But in essence, most of these companies that you see here today will hopefully be in my portfolio 10 years from now, because that's the goal. As a long-term investor, I do have other portfolios other than this, but I'm not going to be focusing on those. I have a 401k, I have an IRA, I'm saving for retirement just like everybody. But these two portfolios are more of an individual stock investment portfolio versus those others, which are essentially, invested in index funds. Because the reality is, if you're a long-term investor, the best thing you can do is essentially just buy the S&P 500, buy an index fund that tracks all of the stocks in any individual market, and just forget about it, right? A lot of people do not have the time to do the analysis on a lot of stocks, and a lot of people just don't find it enjoyable. So for them, the easiest thing to do is buy an index fund. Go to Vanguard, open an account, and buy an S&P 500 index fund, buy a bond fund, buy something that jives with your risk profile. And that's what I do for like 80% of my money. But 20% of my money is allocated to portfolios such as this one and another one I'll talk about later that are invested in individual securities. And essentially that's what I want to focus on in this series, because it's fun. There's nothing wrong with investing being fun. And since I am a finance oriented person, I have a finance degree, I enjoy doing stock analysis, I enjoy looking at stocks. I think it's an interesting hobby, and I just want to talk about that hobby with other people. And this is what I'm trying to do with this series. And I think, these stocks that I'm going to be talking about here aren't anything crazy. They're not wild bets on weird high growth stocks. They're long-term investments that I think have potential to return above the market averages, because that's the goal when you're investing in individual stocks, right? You want to beat that S&P 500 index. The problem with that, and the problem with making that all of your money, is that it's actually pretty hard to beat the average in investing. You can be a professional, you can have tons and tons of people doing a bunch of research for you, and you'll fail. You know, more than 80% of mutual funds, which are managed by professionals who are doing this as a job, failed to beat the S&P 500 or a comparable index, and that's telling, right? So for most people, like I said, the S&P 500 index is enough. For others, if they want to dabble in individual stocks, you know, make that a small portion of your overall portfolio, invest in index funds for the rest, and kind of play around with your money, which is what I'm doing here. And when I say play around, I mean, you know, invest wisely. You know, don't just put your money in silly bets. Don't buy options. But if you have a stock that you like, you know, put a small percentage of your money in it after you do the due diligence and you talk to somebody who's a professional about whether or not it makes sense to make that investment. It's essentially what I'm doing here. And in my individual portfolios, I've been using M1 Finance as the platform that I like. And M1 Finance is a newer platform that essentially allows you to buy fractional shares of companies. And it allows me to buy a bunch of companies that I like with a small amount of capital. So I will talk about this more in future videos, but in essence, my first portfolio that we're looking at here is the Dividend Aristocrats portfolio. It is a portfolio of companies that have grown their dividends for 25 years or more. And I'll talk about why I like that later. But what M1 Finance allows me to do is that with as little as $100, I can buy a share of all of these Dividend Aristocrat companies without having to have a ton of money, right? So I can buy 0.1 shares of all of these 57 companies that are in the Dividend Aristocrats portfolio that I've created, and really have exposure to a ton of companies that I like. And I really like that about M1 Finance. It's difficult to do that with other brokers because they generally force you to buy full shares, and that can be very expensive. You know, certain stocks are $1,000 or $200, and if I only have $1,000 to start with, it's difficult for me to buy a bunch of companies. I have to focus on one or two. But with M1 Finance, I can create what they call pies that allow me to add as much as 100 companies into each pie and essentially buy a very diversified basket of securities for a small amount of money. So this portfolio here, the Dividend Aristocrats portfolio, isn't anything crazy. This is something that's well known by a lot of people out there. What a Dividend Aristocrat is, it is a company that's either that's essentially grown their dividends for 25 years in a row. And what's good about that is that it kind of shows you that these companies can weather bad times and continue sharing profits with their shareholders. And what I like about that is it essentially shows me that these companies are long-term investments and will likely to continue to be good long-term investments in the future, right? So that's why I sort of chose to go with this as one of my individual stock portfolios. It's a strategy that's relatively common out there. You've probably heard of something called the dividend growth investing strategy. This is kind of what that strategy is about. It's buying companies that are making money, and with that money, they're either reinvesting some of it, but also they're paying dividends or sharing some of the profits to the stockholders of those companies. And not only are they paying those dividends, every year they've increased those dividends for at least 25 years. And there's a lot of companies out there like this. But what I'm focusing on is the companies that are like this that are within the S&P 500, which is the 500 biggest companies in the United States by market capitalization. So this portfolio, the Dividend Aristocrats portfolio, essentially takes the 57, I believe there are, companies in the S&P 500 that have not only paid, but also raised their dividends for 25 years in a row. So, you know, throughout 2008, which was a rather murky time for stocks when things were doing poorly, these 57 companies raised their dividends. So they weathered the 2008 crisis well. And not only did they do that and continue paying their dividends, they also raised the dividend that year as well. And the same happened in 2000 and in the other market stumbles that happened in the last 25 years. Now, these 57 companies are solid. They have a good history of paying out dividends, but that doesn't necessarily mean that they are going to continue paying dividends forever. You know, this portfolio may change. I talked about long-term investing, and you know, if these companies continue paying their dividends well into the future, I will never remove them from this portfolio. Other companies may be added to this portfolio in the sense that, certain companies out there right now in the S&P 500 may have a 22, 23, 24-year track record of paying dividends. Once they hit a 25-year dividend mark, I'll add them to the portfolio because they will be a dividend aristocrat, right? There are also companies in this portfolio right now that may cut their dividends or not increase their dividend in the future, right? If we go through a downturn like we did in 2008, some of these companies may say, oh, we're struggling. We cannot continue to raise our dividend anymore. And that is a sign of a business dynamic that kind of changes the way I look at a company like this. It changes the risk. And that means I may have to remove them from the portfolio. So they will no longer be a dividend aristocrat. They will not be in the portfolio anymore. And again, if you are on M1 Finance, I can share this pie with you. I'll add this pie to the list of links that are below the video. If you want to check it out. But I will make a separate video talking about this portfolio in more detail. But for now, I'll just kind of scroll through and you can kind of see that these companies are pretty well-known names. If I arrange them by alphabet, companies that have paid their dividends for 25 years or more in a row generally have a business model that's pretty sticky, that is pretty well-known, and also one that kind of weathers any economic troubles relatively well. So you can kind of see some of these companies, and you probably know some of them. You might not know others, but again, these are relatively large companies that have paid their dividends 25 years in a row, and not only that, but they've also increased them. So there's Triple M company, there's Abbott, which makes the Insure, for example, AbbVie, which has a lot of drugs that you are probably familiar with, AT&T, Cardinal Health, which is one of the biggest companies that sends drugs and kind of takes care of they're kind of the middlemen between pharmacies and companies that create drugs. Chevron, Caterpillar, a lot of good companies here. Coca-Cola, ExxonMobil, a lot of companies you've probably heard of. Hormel, they make a bunch of meat. I don't know if I like their meat. I think they actually make Spam. So Johnson & Johnson, Kimberly-Clark, toilet paper. Everybody uses toilet paper. McDonald's, McCormick for their spices. Lowe's for their home goods. Medtronic makes a lot of medical devices. Pepsi, etc., etc. So, and again, these are companies that have a history of paying dividends. They have a history of growth, a history of growing their earnings, a history of good cash flow. And these are essentially what you would consider a good, stable company. Now, that doesn't mean that I love every one of these companies, but I wanted a portfolio that would kind of take my personal judgments out of the equation. And this is one way to do that. It's just focusing on some sort of financial aspect of a company. And the financial aspect here is that they've paid dividends for 25 years and they're continuing to raise them for that period of time. And if you can kind of arrange these companies by how they've done, Target, and that's one thing about taking your opinion out of the discussion, because when I looked at this list, when I made this portfolio, I don't know, about a year ago, I haven't really put a lot of money into it. I've started putting more money into it recently. When I looked at this list, I saw a lot of companies that I didn't really care for, that I thought were like, I don't know if this industry is going to be around in 10 to 20 years, because that's kind of what I'm investing for. That's the time frame I'm investing for. And Target was one of those companies. I was like, retail, Amazon's out there. Retail's probably done. I don't know if I care about Target. I don't know if I want to include Target in this portfolio. And it's doubled. It's more than doubled since then. So I was completely wrong. And that's the thing about investing, right? That's why people should be investing in index funds for the most part, or why people should have a wide basket of securities when they're investing. You can be completely wrong on something. And if you exclude that something from your portfolio, you might miss out on very high returns. Like Target was one of those companies where I was like, oh, I don't know about retail. I don't know if Target's going anywhere. But my small amount of money that I've put into Target has returned quite a bit since I've put money in there. And these returns, one thing I kind of don't like about M1 Finance is that these returns are time weighted. So it depends on when you put money into that security. So I don't trust these percentages too much, because it's not like 141% return means that it's doubled in this time period. It just means that, if I put $5 in a couple weeks ago, it's time weighted to kind of increase the return for that smaller time period that you're looking at. So, but still, Target's done exceptionally well for me, and I thought it was a shitty company. And it's obviously not. They're doing fantastic. They're they're surviving. They're not only surviving in the age of Amazon, in the age of online shopping, but they're thriving. They're converting their business model into something that does well in store and online. They're upgrading their store. They have partnerships with pharmacies and things like that. They have partnerships with clothing providers that are generating brand, target specific brands that are doing well for children, especially. So things they're doing are great. Things they're doing recently have had great returns, and I was wrong about that. And you can kind of go down the line and see which companies are doing well, which companies are doing poorly. So you can kind of look at companies like M, which I think is a great company, has done really poorly lately. But the thing I like about M1 Finance is that every time I buy something, it kind of looks at this target that I have for these stocks, and in essence, I've split these stocks as equally as possible into Dividend Aristocrats, so that most of these companies are at 2%. Some are at 1 because it doesn't allow you to have fractional percentages. 100 divided by 57 is not going to be 2. It's going to be 1.8. So a couple of companies are at 2, a couple of companies are at 1 that I think are a bit worse. And then what it does is it essentially says, hey, I am going to buy the companies that are underweight, the companies that have done poorly, because they're under your target, when you're buying the next time. So now if a company does well, you're not really buying it at a higher price. If a company does poorly, you may be buying more of it. And the thing I like about that is that stocks often work in a reversion to the mean concept, right? Certain companies do well for a while, then they start doing a bit poorly when they get overpriced, when something happens that makes their business model work slightly worse. And then other companies that are doing poorly right now might change it around, might get appreciated differently by the market, and they'll do well. So you'll be buying the companies that are doing poorly. When they start doing well, you'll benefit. When those other companies that are doing well, that you're benefiting from right now, start doing poorly, you'll start buying those, and you'll benefit there. And it's a good long-term investment strategy, that you're always buying the things that are undervalued, and you're not buying the things that are overvalued, because the market often undervalues things, the market often overvalues things, and the difficult thing to figure out as an investor which stocks are undervalued and which stocks are overvalued. And M1 Finance kind of takes that away from you. It just says, hey, I'm going to buy the ones that are under target. I'm not going to buy the ones that are over target. And then if things change later on, you'll do well in buying the things that are under target, because eventually they'll get over target and you won't have to buy those. So if I look at what I'm buying, I just did a little $100. Whoops, that's not what I want to look at. So let's look at one of these buys over here where I did $200. It essentially, what M1 Finance will do is it'll take those $200 and it'll kind of shoot it into stocks in order to bring those stocks as close to target as possible, right? So you can kind of see that I'm buying quite a bit of ExxonMobil. That was probably slightly under target. I'm buying a few shares, a few dollars worth of Cintas, a few dollars worth of Johnson & Johnson, and so on and so forth, until those stocks are back close to target. So I'm always buying something, and the reason I like this is it's essentially giving me the ability to buy a ton of companies without having to have a ton of capital. So I can buy 47 stocks for $200 and get fractional shares of each, but it's still pretty nice. And those shares will pay dividends. I'm still at a very small amount of money here, so the dividends that I'm getting are not very high. But as the portfolio gets larger, this number will increase, and hopefully the dividends will increase. They will increase, right, as they grow, and these companies keep growing their dividends, and the dollar totals grow. These dividends will be higher. And what's great about M1 Finance is, as with any other broker platform, is it auto invests the money once you hit $10 in cash. So every month, even if I don't invest anything, this month I'm up 2%, and $16 of that is dividend. So even if I didn't buy or deposit any more money in the last month, I'd have gotten $16.55 in dividends that would collect in cash until it was at $10, and then get reinvested into these Dividend Aristocrat stocks as needed based on the target allocation. So that's great. The negatives of M1 Finance is it only buys once a day unless you have M1 Plus, which I do not. So it's not like you're buying at the most opportune time. You can't really do limit orders. So if you're buying just one stock, or if you're buying an index fund, you're better off doing that at like Fidelity or Schwab or Vanguard. But if you want to buy 50 different stocks and you want to diversify right away, and you like 30 different companies or 20 different companies or 10 different companies, and you want to get in on it, M1 Finance is perfect on that, right? And the fact that you're only buying once a day doesn't really matter, because I'm a long-term investor. If I buy something that's a cent more expensive than it would have been if I bought it at 9.45 or at 11, whatever, it doesn't matter. I'm holding this money for years and years and years. So this portfolio, I think, is going to start growing more now, because I'm in a spot where I have more cash available to invest in taxable accounts. I haven't really had that in a while. I got a new job that pays me slightly more, so I'm doing okay there. I'm maxing out my 401k, and I have additional money to throw into a taxable account, which is what this is going to be, right? This portfolio and the other one I'll talk about soon is going to be a growth driver for me, and I'm really going to enjoy kind of doing these videos and looking at how this portfolio is doing and where my money's going, and seeing these dividends grow, because that's the fun thing of investing. And I think why a lot of people like the dividend growth investing strategy is you can kind of go there and say, oh, I have these 30 companies, and hey, Abbott paid me 56 cents this month, AbbVie paid me $2 this month, Clorox paid me $1 this month, Colgate Palmolive paid me 93 cents. And it's like, hey, I'm getting this ownership share of the company via the dividend, and this dividend is growing every year, because I am, at least in this portfolio, I am invested in companies that are growing their dividends, that have grown their dividends for 25 years in a row, and that's fantastic, right? And right now I only have $8,000 in here, and this portfolio yields something like 2.5% or maybe 3%. I don't even know. Let me see if I can see if this has the yield. Yeah, it yields 2.4%. So essentially what that means is, if I do the calculator here, 8554, 0.024%, it means I'm getting a $205 in annual dividends. So it's not a lot, but it's pretty good, right? $205 for $8,000 in invested capital. That's probably going to grow. That's why investing rocks, right? You're getting this share of the profits that the company makes, and not only are you getting that, the stock value is increasing because they're growing those profits, or they're doing something, or they're purchasing other companies, or they're buying back shares. And this $205, because these companies are growing their dividends, is probably going to be higher next year. Maybe it'll be $207. And not only that, if you don't need the money right now, you're going to reinvest that $205, and $205 reinvested is going to get you $5 in dividends a year, just from that reinvested capital. Plus, you're adding money to it, so it's like this. That's why people invest, right? It's the compounding effect of investing. You invest, your investment grows, you gain dividends, you reinvest those dividends, and the investments that you already have, plus the growth, plus the additional money you're throwing in, generate more dividends. You reinvest those dividends, et cetera, et cetera, et cetera, and eventually you start making a ton of money from dividends, right? Right now, I'm not there. My portfolio is $8,500. My dividends in the last month were $16. In the last weeks, they were $3, and the market has shrunk $63. So in the last quarter, my dividends were $44. So this isn't a lot of money, right? But this is where you start, right? This is the starting point. And the more money I put into this, the more dividends I'm going to get, the more growth I'm going to get. And that's the long-term goal here, right? To increase the value of this portfolio, to get more dividends, to reinvest those dividends, eventually use those dividends for living expenses once I'm much, much older, right? I'm 35 years old. I still don't need this money for a long, long time. So I'm leaving it in here. This portfolio, the Dividend Aristocrats portfolio, is going to be relatively static. Companies will be added if they meet the criteria of being a Dividend Aristocrat. Companies will be removed if they lose the criteria of being a Dividend Aristocrat, i.e. they do not raise their dividend any given calendar year, or they shrink it, right? Those are the criteria to be a Dividend Aristocrat. But for now, these 57 companies are in there. Every time I add $100, it will be invested as it had been over here into these various companies. These companies will pay me a dividend, it will be reinvested, etc., etc. It's great. I really enjoy the M1 Finance platform. I'll share a link to it if you want to use my affiliate link. That's cool. If not, if you're signed up already, I'll share the pie as well at the area below. And that's my Dividend Aristocrat portfolio. The other one that I have, and I think this video is a bit longer than I expected it to be, and I'll talk about this one in more detail later. I have another portfolio that's more industry focused, and this is more of a long-term approach to investing in industries and companies that I really like, but I wouldn't normally invest in because I have a risk profile that kind of tends to make me invest in index funds more often. Right? Like I said before, most of my money is in index funds, S&P 500 funds, international index funds, REIT, R-E-I-T, real estate investment trust index funds, bond funds, and a lot of those, especially the REITs and the bonds, are in tax advantaged accounts like in 401ks. Because I'll talk about this later. You don't necessarily want a lot of your high income plays to be in a taxable account because that's less efficient than having it in a tax advantaged account. But that's a story for another video. So this industry investments portfolio is one that I made that essentially has a variety of slices in it. So it's not just one slice like the other portfolio that has the Dividend Aristocrats. These are industry related slices that have different companies that are within that industry. And some of these industry related slices have a higher target because I believe in them more. Some of them have a lower target because I believe in them less, or there's simply less companies in there that I think are worthwhile to invest in. So like, for example, I have a slice that's called AI, Cloud, Health, and Technology, and you can probably tell what that is. It's companies that deal with artificial intelligence, cloud, which is, all the storage in the cloud, healthcare, health technology more so than healthcare. Like, I don't have health insurance companies in here. It's more health technology companies and technology in general. So like companies like Microsoft, cloud technology, Google, the Trade Desk, Thermo Fisher Scientific, Adobe, Apple, Okta, ServiceNow, Lumina, Facebook, Nvidia, Jilliant, Oracle, a lot of companies in here, even Amazon. Some of these companies have done fantastic for me. Apple, one of them that I actually own in another account as well. That's one of the few individual stocks that I own outside of this. And the other companies have done poorly, one of those being Amazon, which is surprising. But again, I think these are all very long-term investments. Some of these stocks are pretty expensive right now, as tech has been in favor for quite a while from a at least a current price over earnings or current price over cash flow or current price over sales metric. Some of these are pretty expensive, but I think tech is really the wave of the future. The companies that are here are going to be the ones that are changing the world in the next 10 to 15 years. If I go back to this portfolio, a lot of these companies are fantastic companies, but they're companies that have a certain niche. They are like Colgate Palmolive. They make toothpaste and cleaning supplies. Good company. They have great predictable cash flows, but they're not really like growing super fast, right? There's only so much you can do with toothpaste and cleaning supplies and things like that. The couple companies, Hormel Foods, right? They're not like going crazy. They may move into alternative meat supplies or something like that. Maybe something will happen, but I really, for a lot of these companies, I don't expect them to like explode suddenly, be like, oh, this company's up 100% year over year. And sometimes that happens, right? Target's been ridiculous, right? And it's a store, it's a big box store, so you can't predict these things that the company will get revalued by the market, right? Target hasn't necessarily like grown a lot recently, and that's why the stock has increased in value. It's just that Target's been essentially evaluated by the market, and the price has shot up because the market has given it a different pricing metric. A year ago they were like, oh, retail is dead, let's give it a 10 price over earnings metric, and suddenly it's like, oh, retail maybe it's not dead, right? Maybe things are not as bad as they seem. That's kind of bring it up to a more market average pricing metric so that the stock actually does well without having to grow a lot. And that could, if I go back to this portfolio, the opposite can happen here, right? A lot of these companies are currently valued very favorably by the market. You look at something like, I don't know, some of these growth companies that are are valued at like Amazon, maybe one of those, although I think they're valued pretty fairly by the market right now, where their PE is well above the market average. But that's because they're growing really quickly, right? And similar for Facebook, similar for Google, you know, their P's are in the 30s or something like that. I haven't looked at it too recently, honestly, so don't take that for gospel. But some of these companies, like some of these fintech companies, like Square, you know, they're not really earning a ton of money in earnings right now, but they're valued very high. So there's risk in that if their growth doesn't materialize, you could lose a lot of money on this stock. So this is more risky, I think, but it's also got a higher potential reward. Some of these industry investments are growing and they're priced appropriately for that growth. And if that growth doesn't materialize, you could not do as well as you'd expected, because their PEs will shrink, their earnings will not be as they were expected, and the value might not be there. So I think this industry investment pie is probably a bit more riskier than that dividend aristocrat pie, and that has to be accounted for when you're investing. It's also done worse recently, but a lot of that is because when I created this industry investments pie, I had some stocks in there that I didn't really like, but I put them in there because they were like hot growth commodities. They were like, you know, a couple of those marijuana stocks were like, whoa, this is the next wave. But I was like, well, you know, I want some exposure to some of that. I don't really think they're good companies. But I wanted some exposure, and that's kind of what I was going with this portfolio. And I've since changed that, and I've made it more of an industry-specific bet for companies that I actually like versus just growth stocks that I don't want to miss out on. So, like, you know, initially this addictive area had some marijuana stocks in here, and they did like horrible for me. They were like down 60%. So I just said, you know, I don't really believe in the stocks anyway. So why do I even have them in here? And if I want to share this portfolio with others, I want it to be companies that I kind of believe in, that I think are decent companies, instead of like just, you know, hot growth commodities that are just getting overpriced by the market. And if I don't believe in the company, I don't want it in these industry spots. So, you know, I've got other slices here. Autonomous vehicles is one, and I think that one's not done very well for me, and I've kind of shrunk down the pie, and I've made other pies more of a higher target than autonomous vehicles, because I don't know if I believe in it that much, and some of these companies aren't companies that I love anyway. But I think, you know, it's still worth investing in, and that's why it's still in my industry investments, and that's why I'm sharing it with you guys. Again, I'll share the pie on the bottom if you want to look at it. This one has a much lower dividend payout. It's not really a dividend focused pie. I think the payout's actually under 1%. It's got 87% holdings. A lot of these companies do not pay a dividend because they're growth companies. They're tech companies that are still growing, that are reinvesting their money. And there's, you know, the sports teams. I'll kind of do a separate video for each of these portfolios later on. I just wanted to let you know what they are in case you want to take a look at them. Right now, this portfolio is about 11 grand. It's grown pretty well. I've added a bit more money in here recently. If you kind of look at some of these rebalances I did, it's because I changed the portfolio, like I said. Recent buys, you know, you can kind of see what I had here. I had some of these stupid stocks that I no longer have in there. But for the most part, I think I'm pretty happy with where this portfolio is now. There's a couple of stocks in here, you know. So Tesla is a stock that was in the news today, and I kind of wanted to talk about that. They released their new car today, and when I look at these industry investments, I kind of have a lot of stocks in here, but I don't want to make it too big, because I still want to keep an eye out on what each of these stocks are doing and kind of read the news and look at the earnings. And it's hard to do that with a lot of stocks. Even 87 is a bit too many. But a lot of these companies I'm pretty familiar with, so I don't need to keep too close tabs on them. Some I'm not, so I kind of keep a closer eye on them. And Tesla is kind of one of them, because Tesla isn't really a mature company yet, right? They're still growing. They're priced very aggressively by the market based on pretty much any available metric. They're not really making a ton of money. You know, if you look at something like General Motors stock and a Tesla stock, right? So a General Motors stock has a $50 million market cap, 50 billion, sorry, and Tesla's at 59 billion, right? So Tesla is priced higher than General Motors, and yet Tesla has like, I don't even know what the revenue difference is. It's a small percentage of what GM is doing, right? But Tesla's doing something new and exciting, and the market prices it because it's new and exciting. And Tesla has a lot of growth opportunities, right? And Tesla is doing something different than GM, right? The market looks at GM and says, you know, GM's an old company. They're not really growing. They're potentially getting pushed out by all these new companies that are coming in like Tesla. So I'm not really going to price it that aggressively, right? And I still have GM. So like if you look at my autonomous vehicle, I have GM in there, right? Because they are working on autonomous vehicles. But, you know, I have a smaller percentage than Tesla because Tesla is probably more at the front line of this change. And if autonomous vehicles are the future, which is kind of what this is all about, this industry investment, it's taking a bet on an industry that I won't have represented in any of my other investments, right? If Tesla is the future, then I want to have some money invested in there, and that's what I'm doing here. But you can kind of see what Tesla's doing. They've got this new truck that came out today, this Cybertruck. It's absolutely insane, right? Its technology is crazy. It goes from 0 to 60 in like 3 seconds. It looks ridiculous. I mean, it looks like something out of a Blade Runner movie or something out of a 1970s future catalog. Like, what is the future going to look like? Well, it's going to look like this. It's weird. It's like a DeLorean mixed with a warthog out of Halo, and it's just they're doing a lot of crazy stuff. And I think it actually looks cool. But I like it when companies do something that's different, right? Because they're taking a risk. They're trying to change something about an industry that, you know, may be stuck in a way. Because, like, honestly, you know, I have a standard car, but if I think about the next car that I'm going to buy, I think it's going to be something that's going to be different, because I think we're far enough in the car technology process where electric cars are getting to a point where they're starting to make sense. You know, my apartment complex has like 12 different charging stations that you can use for free. That wasn't the case 5 years ago. You can go to a lot of stores. They have charging stations that you can use for free. The infrastructure is getting built out, and it's not quite there yet, but it's getting built out in a way where electric cars are going to make sense, you know, 3, 4, 5 years from now. And for some people, they make sense now, right? So Tesla's not making a lot of money right now, but if they're doing something that's completely different than what everybody else is doing, you know, the market is a forward-looking mechanism. They're looking at Tesla and saying, you know, Tesla's doing something, right? They're doing something right. The people who have Teslas, they love them. They can't talk enough about them. The revenue's not quite there yet. The free cash flow is not quite there yet. The risk is still there, but they're doing something right. And, you know, a lot of people aren't going to like this car. I've seen a bunch of memes out there that say, oh, this thing looks ridiculous. It looks like a DeLorean. It looks like something silly. I think it looks kind of neat, right? And what I found very funny is if you haven't seen this video, when they were doing the demonstration, one of the selling points of this car is that they have this glass on it. They did a test right before this happened, and I'm going to show you this video. They did a test right before this happened that said, hey, we're going to drop this big metal thing onto this pane of glass from way high up, and it's going to do no damage. And it did no damage, right? I'm not going to show you the thing, but it did no damage. And then Elon, who's the CEO of Tesla, if you're not familiar, kind of asked the guy to do something, and I think what happened was absolutely hilarious. And I just wanted to show you this. And
Franz, could you try to break this glass, please?
So he asked the guy to break the glass, and again, this car, it looks weird, right? I mean, look at it in the back, and I think when you open this up, it kind of like opens up, and you can put an ATV in there. It's got a lot of storage. It's a truck. And again, this thing looks like it might move like 5 miles an hour, but it goes, again, 0 to 60 in like no time at all, and it starts at 39K. It's if you're looking for a weird truck, this is the truck for you.
Yeah. Sure? Yeah.
You sure? Oh, crap. Oh, that was hilarious. He's like, oh my effing god. Oh, Elon Musk is a weird guy, and I don't know why they would do something like this live in front of a crowd, streaming it online. And did they not test this? He was just like, oh, let's throw it at the glass. And the glass breaks, right? I don't think that was what was supposed to happen, right? It was a very awkward moment, but it's just, it's funny. I thought it was funny. As a Tesla investor, it's not great, because if you look at the stock today, it's down 6%. People kind of looked at this truck and said, you know, this is weird. And obviously the fact that one of the things that they were touting as, glass that's essentially as strong as armor was broken by some little metal thing by a guy barely throwing at it. It wasn't great, but I just thought it was funny. Does it make me want to invest more in Tesla? Not really. Does it make me want to invest in less in Tesla? I not really. I have a very small amount of money invested in Tesla. I have like $48, right? And that's the beauty of this thing. If the thesis on Tesla changes, and it really hasn't done well recently, down 19% since I've purchased some of it. If the thesis on it changes, I'll lower this exposure to Tesla. But again, it's 11% of my autonomous vehicle pie, which is only like 4% of my overall slices, right? So 4% of my $10,000 goes into that, and 11% of that goes into Tesla. So again, very small exposure. I'm not really concerned about it. And I think it's worth taking a risk on it. And that's kind of what industry investments is about. It's like, do I take some calculated risks on industries that I think are going to be great 10 years from now? And I am, right? And if you want a more stable investment profile, then I think this portfolio is better for you, because it's going to have companies that are historically proven. Doesn't mean that they're going to be great in the future, but historically they've done well. That's really the tough part with investing. Who knows what's going to happen in the future? It's all forward looking. This has done well in the past. It's continued to raise dividends in the past. Is it going to do so in the future? Some of these companies 10 years from now are probably not going to be in this portfolio. There's going to be new ones in it, but overall it should do okay. And then this is, companies that are sort of in industries that I think are going to do well in the future. Autonomous vehicles, people love their pets, got to have pet stocks in there, e-commerce, video games, entertainment, space technology. And a lot of these stocks, you don't really have a ton of companies that invest in space right now, but it's companies that deal with like government contracts and AI, again, which is kind of covered in here, and just technology, airplanes, et cetera, that it's going to transition into space if it happens, which it will. But again, these are two different portfolios, two different strategies, and hopefully this video kind of gave you an idea of what I'm about, right? I am a long-term investor that wants to have some fun with investing. I have two portfolios here on M1 Finance that I think have two kind of separate investing strategies. One is dividend growth investing in the Dividend Aristocrats portfolio. One is industry growth, industry-specific bets with a focus on kind of growth companies that I think are going to be big in the future. And this is going to have probably more flexibility in terms of when and if I remove companies, right? I'm at 87 holdings here. I may remove some, I may add some, depending on what happens with a lot of these companies. This is going to be more malleable than this one. This is really only going to change when a company is no longer a Dividend Aristocrat, or when a new company gets added to the Dividend Aristocrat 25-year plus dividend payer club. Whereas this one is if, hey, it might even get a new slice. If a new industry is out there that I missed or that I want to invest in, maybe I'll add something in here. Again, not very dividend focused, which is good for taxable accounts because you don't really want to pay dividend taxes on dividends. It's more growth and gain focused. In recent times, it hasn't done superbly, but I think it's going to do well in the long run. This is also more risky. I think if we have a recession, these stocks, because they're focused on technology and high growth companies, are going to fare poorly. These stocks are still probably going to drop in a recession. They're going to fare less poorly because people tend to search for safety in a recession. So two different strategies, two different ways of looking at investing, but hopefully both will do well. Hopefully I can grow this portfolio. Hopefully I can share this journey with you guys. I think what I'll do with these videos is I'll kind of go over how things are going. Maybe I'll do them once a week, maybe longer, depending on what's going on in the market. I'll kind of talk about the market itself from time to time in these videos. I'll talk about any interesting articles that I find about some of these companies. Maybe I'll do some financial analysis on a few of these companies as time goes on. But essentially what I'm trying to do here is share my journey, have some fun. Leave some comments if you have any thoughts about what you think I should do. Leave some comments if you have any thoughts about the video at all, or what I did well, what I didn't do well. Again, this is the first of many episodes. Hopefully the quality gets better as it goes along. I didn't really have anything planned for this video. I just kind of sat down and thought I'd talk. Again, I am not a financial advisor. You should do your due diligence and talk to a licensed financial advisor before you use any advice in this video. And just trying to have some fun here, trying to share my journey. Hope you guys enjoyed. Thanks. Again, my name is Yadek, first generation immigrant, woohoo, investing in America, investing in companies that I think are great, participating in the stock market, having some fun, really enjoying the process and hoping to share my journey and the growth that I experience with you. And even, I think it'll be interesting when we have a recession to kind of chronicle that and then see what's going on, see how people are reacting, see how I'm reacting. Maybe I'll panic and sell. Probably won't, because I've been through one before in 2008, and I think it's a good opportunity to buy. But I think it'll be good to kind of have somebody to be accountable to make sure that I'm continuing to grow this, make sure that I'm investing regularly, and make sure that I'm having fun while investing. So thanks for watching. If you like what you're seeing, subscribe. And